Hey guys, it's Josh Brown. We are here to play another round of What Are Your Thoughts? I'm with Michael Batnick, as usual. Michael's wearing the official Animal Spirits Podcast Noob Whale shirt. Are those shirts still available?
Yes.
They are, but they're for charity, right? Like all the money went to
Well, the
something?
first wave of money we gave to charity, and the next wave is like $3 trickles in here and there.
$3 trickles. All right. If you want the Noob Whale shirt, where can you buy it? I don't even know.
I don't know. On my pot.
You're not good at selling these things. All right, listen, we're going to talk about the hottest topics in finance and on Wall Street today. Michael's going to be a little bit more cooperative as we get going.
What does that mean?
What? You don't even know where to buy the Noob Whale shirt. How do you expect people to get one?
It's on my website.
Oh, all right. So isn't that a better answer? Stick around. All right, Mike, I'm going first. And
we're gonna change it. We're gonna change it up, huh?
No, we're not going to change it up. So I wanted to ask you about the Disney announcement last night. And I know you and Ben on Animal Spirits have been talking a lot about the streaming wars for the last year or two. And you've got two young kids, so I know you're probably knee deep in Disney and Netflix too. What'd you make of like what they're saying? To me, it seemed like nothing really changes at all. But maybe I don't know what I'm talking about.
When you say nothing, what do you mean?
Well, the stock price like went crazy. But what are they really doing? They're making one person someone else's boss? Are people just like out of ideas?
The stock's up 3% today. You know what surprised me was Dan Loeb was pushing for this like a week ago. Is it possible that they really were like, oh, he's right, and then 3 days later they instituted this, or do you think this was already in the works?
I think it's definitely possible. I think like
really
this is a moment where companies are just like going for stuff that they normally would deliberate over for a year. Like they're just like, yeah, we're a streaming company now. We happen to have an amusement park.
This is surprising. Netflix has a larger market cap than Disney. That sounds wild.
This is Dan Loebs Point. So Dan Loeb is activist hedge fund manager at Third Point, and he's had a recent successful activist campaign with Sony, convincing them that a lot of the stuff they do, shareholders aren't giving them credit for, and what they should prioritize. And what he's saying with Disney is, look, why are you going to pay out a $3 billion annual dividend? It's like a 1.5% yield. Nobody cares about it. No one wants it. The best evidence on his side is that they suspended it for the first half of this year because of the pandemic, and the stock actually went up. So it's like, well, why are we even doing that? Let's take that multi-billion-dollar payout to shareholders and invest it in content, which is the future of the company. And I think the street agreed with him. And I think that's evidenced so they come out last night and they're like, we're going to restructure everything so that the center of the whole universe is content and distribution. And it's going to come through like three very specific segments. And basically what they're saying is we have these amazing properties. There's going to be one central person that's going to decide where they go when we create these things. So we're working on a new Star Wars thing. Someone says, this is for theaters. No, this is for the app. No, this is for a cable channel or whatever. Like, is that what you got out of this?
So Netflix has been at this for about 20 years. They've got 180 million subscribers.
Yeah.
Disney launched, I think November, was it 2019? So not even a year old. They're already at 100 million paying subscribers.
Yeah.
So they're about half the price.
They're paying nothing.
It's like $7.
$7. It could double and people would still pay it. I assume it will double.
So I'm curious to see what they're going to do, if they're going to do more of the Mulan stuff. So Mulan went straight to the platform, but you still have to pay $30 for it. I don't think they released financials on how that did.
I don't think it was a hit because they would have told you how many people watched it if it was a hit.
That's true.
Disney also has to do a lot of like very China-centric content because of how important China is for both their present and their future. So Mulan might not have been a hit in America, but it's probably beside the point if it worked over there. Which again, I don't know if they're even sharing that. I wanted to run through some metrics with you. I'm doing this on Y charts. But so Disney market cap 234 billion. It's a 46 times forward earnings expectations. So the forward 4 quarters. Netflix is a $241 billion market cap, and they're getting an 88 multiple. So they're getting almost double the forward PE ratio. Why? Because they don't have the encumbrance of ESPN and theme parks that are closed? Or is there more to it than that?
I mean, I think that sounds simple enough.
Why doesn't Netflix just buy an amusement park? They could probably get one for free right now. All right. And on a backward looking PE ratio, just for fun, Disney 38 times earnings, which is not a cheap stock.
Jeez.
But Netflix 92 times
Well,
earnings.
I mean, we know Netflix is not concerned about earnings right now. They're still in hyper growth mode.
And Netflix shareholders are not concerned with earnings. And I think that's Dan Loeb's point. If you reorient Disney around a new story about how many recurring revenue paying subs we're going to get, and then you listen to like Scott Galloway, who did this huge thing on how Disney should be doing education. They should like take over virtual learning, and they could get so much more money for so many different subscription products, or collapse it all into one and everyone's going to pay. Which I've always said, as soon as Disney launches, everyone's going to pay. So I think if they can tell a different story to the street about being an annually recurring revenue company versus I hope somebody buys a DVD company, which is what they used to be, the multiple the gap between Netflix and Disney should collapse, no?
All right, let's stick with this theme, tech monopolies.
Okay.
So the Subcommittee on Antitrust, Commercial, and Administrative Law of the Committee on the Judiciary published a report that's, I don't know, 3 gazillion pages long. Investigation of
That's how you know it's good.
Investigation of competition in digital markets, literally 451 pages. And the companies that they were investigating specifically are Apple, Amazon, Facebook, and Google.
Yeah.
So no Microsoft, no Netflix, no Nvidia. And I want to bear with me. I just want to read one thing that they wrote. They said, although these 4 corporations differ in important ways, studying their business practices have revealed common problems. First, each platform now serves as a gatekeeper over a key channel of distribution. By controlling access to markets, these giants can pick winners and losers throughout our economy. They not only wield tremendous power, but they also abuse it by charging exorbitant fees, imposing oppressive contract terms, and extracting valuable data from the people and businesses that rely on them. And they just keep going on and on. So Ben Thompson at Stratechery had a rebuttal to this, and some really good points that he made. Basically, that the people that are investigating just misunderstand a lot of the differences in these business models and completely omit the fact that these are universally pretty much adored by their consumers.
Well, that's the main point that he makes, and he's made before, is that if you're going to do an antitrust thing against big tech, you're going to have to almost rewrite what it means to say that something is a monopoly or something is a trust that's causing harm, because what all of these companies have in common is they actually make people's lives better. If you told people we're going to break up Amazon, it's too convenient for you, the consumer would be like, what are you talking about? And so the framework of traditional trust busting doesn't work. Traditional trust busting, Ben Thompson's point is, traditional trust busting was necessary because basically it was cartels, or it was companies that formed, this situation where they had a stranglehold on the supply of a product and you had to buy it through them, and they could be abusive about what it costs. And this is the opposite. Big tech is driving down costs.
And so a lot of the laws are just antiquated at this point.
Well, they don't apply. So now, if you want to do like privacy stuff, well, you don't need trust busting or anti-monopoly legislation for that. That's something different. That's like we say one thing in our user agreement and then we use your data for something else. That's more straightforward. But if you just want to say Facebook is too big, it's really hard to say that and prove it, because Twitter exists and Pinterest exists and Snapchat exists, and these are massive companies. So it's really hard. Facebook just happens to be great.
Well, if you're not, yeah, but you can make the case from the advertising point of view that it's a monopoly. That them and Google just basically control the market, not on the social media side, but on the advertising side.
Go look at this stock. I think it's TDS. It's called the Trade Desk.
There was an article in the FT about them yesterday.
Okay. The Trade Desk makes a new all-time high
It's
every single day
TTD.
the market opens. TTD. So I don't own it. I don't know why. I've been following it since it was $200 a share. It's like 600. The stock makes a new high. I get an alert on my phone for a certain group of stocks that I'm following when they make new record highs. Every single day the stock market opens, the trade desk makes a new high. I swear to God, I think it's 5 days a week.
New high
every
today.
week for months and months on end.
But they're
This
tiny.
is a
They're tiny.
Doesn't matter. It's a legitimate competitor to Facebook and Google. It's an online advertising concern that offers legitimate competition.
Let me ask you a question. Do you think that investors should be worried about regulatory risk?
Not based on this report.
How about what happened? How about yesterday? These stocks were up 5%.
Yeah, because these stocks don't care because they know that there's no serious bipartisan effort right now
So investors don't
underway
care.
to do anything. No, investors would care if it really appeared that conservatives and liberals, for either the same reasons or different reasons, were about to team up and come after these companies. They're at greater risk in Europe than they are here, and that's been the case for years now.
By the way,
So
how about IBM spinning off their legacy business?
IBM, the whole thing is a legacy business. What's going to be left?
The cloud.
The men's room? What? I got no take on IBM.
What do you got?
I'm not the right guy for that. All right, I want to talk about Q3 earnings. So earnings season unofficially starts today. JP Morgan reported this morning. I guess people liked it.
Citi
Less
too.
money. Yeah, less money being put aside for loan loss provisions, which is good. It means, I guess, the bank has more confidence that the recovery is underway and they don't need to reserve against as many losses as they had to last
market's
quarter.
been open for almost an hour and the JP Morgan went negative. I mean, big deal, but it is negative.
Yeah, it's not so great. But earnings in general. So Barron's did a thing. They were talking about. Here's what I wanted to ask you. So at its low, the stock market collapsed 32%.
34.5.
And earnings for the second quarter dropped 32%. So I feel like, is that just a coincidence?
Yes.
Because it's literally perfect, right?
Mm-hmm.
Okay. This quarter, we're supposed to be down 22% over the third quarter of 2019, but that number has been revised higher throughout the course of Q3.
Right, getting less bad.
Yeah, it was supposed to be much worse. And I think for the fourth quarter, we're still supposed to be a loss over Q4 2019, but that's now in the teens. We could potentially be positive year over year by Q1 at the rate that the economy is recovering. And if you would have told me that that's the place that we would be in 6 months ago, I guess like instinctively, not knowing anything, I would have said no way. What would you have said?
Correct. Not a chance in hell.
Not a chance, but here we are. Like we like 2021 might be higher earnings than 2019. And that's with this massive crash / recession sitting right in the middle.
Did the stock market get it right? The stock market was able to look past 2020, apparently.
The stock market has so far gotten it right, unless all of a sudden these Q3 reports come in and Wall Street is wildly wrong, which doesn't frequently happen. If anything, what usually happens is somewhere between 67 and 72% of S&P 500 companies report better than expected earnings per share than what the street is expecting right now. Like that's typically the history. And if that takes place, I just think the recovery in earnings, it may not match the recovery in stock prices, but it's not bad.
Okay. A few weeks ago, you spoke with Logan Motoshami about real estate. And he's been pounding the drum on this for a while, that this is always a 2020 to 2024 story because of the demographics lined up. And Bill McBride had a chart we'll throw up here about age demographics. And people my age there's a lot of people like me that are getting to the age where they move out of apartments, they start having kids, and they need more space. But not everybody can afford a down payment. Not everybody necessarily wants to buy a house. So there are companies like Invitation Homes and American Homes for Rent where they are buying up single-family houses and acting as a landlord and leasing them to people. So Invitation owns 80,000 houses, for example.
I own this, right?
You do? I did not know that.
Yeah, it's like one of my biggest individual stock holdings. It's a REIT, but
you know what? I own it too. $450. No, I'm not joking. I do own a tiny bit of it. I didn't know you own it. That's interesting. But anyway, so what are your thoughts? You think there's a real thing then? Apparently.
Yeah, I bought this 3 years ago when it first came out. So Invitation Homes is not currently buying up houses, although they're going to start to again. All of the homes they own, or pretty much most of the portfolio, comes from the financial crisis. 10 years ago, this was Starwood Lodging, had its own version of this, and Blackstone, and the two merged, and they became Invitation Homes. And I bought it just prior to the merger, so it's probably 3 years now. And what they've done is they've consolidated the houses they own. They're just in like 12 or 16 of the best cities and metro areas around those cities. And when I say best, I mean like the demographics are great, the jobs situation is great, the climate, young people are moving there. So they're in California, they're in Florida. But they're not like randomly, they're like in very nice towns with good school districts, and they're betting
Chicago, Dallas, Denver, Houston, Las Vegas. So anyway, I guess you're bullish on this idea, because I think that this is going to be big.
Dude, my friend is like a home builder where we live, and I was talking to him about like a few years ago, like, oh, I want to diversify away from the stock market. Like my whole livelihood is based on stocks and bonds. I want to do real estate, and he's like, schmuck, you don't know what you're doing. Just buy publicly traded real estate, and you'll get the dividend distribution, and you won't have to put in any work, and you're diversifying somewhat, but you're not going to get your ass kicked by real developers, because guys like me who know how to buy land, know how to get loans, know how to do building, know how to do renovation, we're going to run circles around you. So I started putting money into a handful of REITs. It was like one of the smartest things I've ever done, is to understand my own limitations. This was one of them. And I do think people your generation, they're not going to want to stay in apartments forever. They are going to want houses, but they're not going to want to be tied down to one specific house or one specific community. The rental option is sick because it lets them do that. Plus, they can buy all these a la carte services from companies like Invitation, like having a whole multimedia system put in, alarm system, landscaping. They don't have to deal with any of that. It's just a line item on a bill.
If there's a leak in your roof, you're not on the hook.
But you don't own the house.
Right.
You're renting the house. Somebody else has to deal with it.
So there's trade-offs. I mean, you don't have the liability, but you also don't have the asset 20, 30 years.
Yeah, you're not building equity. So you have to decide whether or not you care about that. Right. Some people don't. I want to ask you about this story at the Journal about Silicon Valley pay. And I was saying, like, I knew there was another shoe to drop. It seemed too good to be true. So obviously, the large technology companies and even not so large startups have a lot of their employees in places like San Francisco and Palo Alto and New York City. And they've now said, like, okay, nobody has to come back to work. Like, we're cool. You're remote. But now they want to start cutting people's pay because they have people like literally leaving, going to Salt Lake City, going to Wyoming, going to Montana. Why should they pay them San Francisco level wages? It makes no sense. There's no reason they would have to. So that's like the other shoe to drop. Like,
what do you mean?
You're not going to be able. So if you were being paid $1 million a year because you had to afford to live in San Francisco, and then you tell your employee, let's say it's Facebook or whatever, oh yeah, we moved to St. Louis, where my wife's parents are from, they're not going to keep paying you $1 million a year to do the job remotely from St. Louis. So there's this really big story about how technology companies, they're going to start getting smarter about who they're paying to live where. What do you think about this?
I think it's fair. I mean, I do. I understand.
Fair for the employer to be able to have that.
I do. And I understand why people might be upset with it, but I do think it's fair.
Here, companies point out that changing pay based on the local cost of living is standard practice for many organizations, including the federal government, with decisions to raise or lower salaries related to housing costs.
Now, let me ask you this, though. I do think it might be penny wise, pound foolish, because what if this really makes people feel shitty and it's just really bad for employee morale? And so you save money, but you end up getting disgruntled employees and resentment and things like that.
I thought about that. You know why they don't reduce people's salaries on Wall Street in a recession? They just fire them. Because they've already learned that you can't keep somebody and have them doing the same amount of work or even more sometimes and pay them less than what they made for doing that work a year earlier.
Yeah, I agree. People live in nominal terms. So even if their cost of living is lower in a different city, or if they go to the country or whatever, they're still getting a lower paycheck, and it's not going to feel good. So I think that this is complicated.
It's very complicated because if you're the employee, you're not thinking about it in terms of like an adjustment because your cost of living is lower. You're saying, yeah, no shit.
Yeah, my paycheck.
That's why you're saying that's why I moved here.
Right.
Because I want to live better based on my income level. I want a bigger house.
So let's say that you moved to wherever, somewhere where you were used to paying $5,000 in San Francisco for rent, and now you're paying $2,500. So your rent gets cut in half, which for most people is a big expense, but your paycheck goes down by 20%. Even though you might be better on a real terms, you're not feeling too good.
Yeah, you're like, are you
got to
kidding
pay?
me?
You got to pay cut.
You got to pay cut no matter what. No matter what. And you could put cost of living data in front of me and I'll rip it up and spit on it. That doesn't do the trick for me. So I think it's going to be tough. One interesting byproduct of this is if a lot of creative kind of industries, technology, media, marketing, whatever, start doing this, you're going to purple up some of these red states a little bit more than you already have.
Yes.
So because you're just going to if you keep finding ways to hire people for less money, and it's not because they moved, but they already live in these secondary and tertiary metro areas, you are going to some extent, create environments where more people want to live there. So it'll be interesting to see. I know that's happened in Colorado. I know Austin is sprawling outward, and as a result, Texas is purpling a little bit. So that'll be interesting, but that'll move at a very slow pace. All right, what do you got?
So Y Charts did this report on presidents and the election and markets and things like that.
Yeah.
And this is interesting. I mean, it only goes back to 1950, so take this with a grain of salt. But Republicans do better in the periods from the election to inauguration, 1.5% versus 0.9% for the Democrats from the election to inauguration. But time in office, annualized, Democrats do 12%. Republicans have done 3.5%. Now, you need caveats there, obviously.
What are the caveats?
Well, Obama got in office at the bottom or close to the bottom, so he had the benefit of that. Clinton just so happened to be there for the 90s, for the dot-com party. Like, the president does not control the business cycle. They're important, obviously, they matter. But I think the bottom line with this stuff is, I think it's foolish to say that politics don't matter at all to your portfolio, because of course there are things in the sense that they do. But this idea that you should invest based on what you think is going to happen with the election is completely absurd.
This guy, Wall Street Ranter, did a guest post on my blog, and like without going through the whole thing, he basically said every unified Republican government in history has led to a financial crisis or a market crash or both. And he actually went through every administration, Republican president, that had both a Republican Senate and House.
Why? Because markets were too free and people were just running wild?
I mean, this will be controversial, but right. His theory was like, when you get a unified Republican everything, they basically deregulate as far as the eye can see. They allow for an environment where people are just like outright going for it, and there's corruption and
all right,
on
fine.
and
But
on.
so let's just say that that's true, and you take that at face value, and the Republicans somehow swapped. We know they're not going to, but let's say they did. Would you do anything differently to your portfolio based on that information? Of course not.
No, because one of the things in his post is just like yes. Like, all right, so like so the answer is yes. Like there is a financial crisis that you can point directly to a unified Republican government, and that's not what we think is going to happen this time. But the timing of it is, so to your point, like makes it so that it's probably not the kind of thing that you would want to adjust a portfolio based on, even if you buy into that, which I don't buy into. I don't believe that we can't have a unified Republican government that doesn't cause a crash. It just says that we haven't yet. But it doesn't mean it always will happen. But that's not even on the menu right now. What's on the menu right now is how badly Biden beats Trump in the popular vote, whether or not Trump can still pull out enough states in the Electoral College to stay, and if either one of them is even going to concede. Like, that's really what we're facing right now, not a unified anything. So I guess it's better to adjust your expectations and to stress test the durability of your current portfolio than to try to change it into something it's not. And I think you'd agree with that, right?
I would.
Okay, but not everyone would agree. So we want to hear from you guys.
Hang on.
Oh, we have a 7th topic today.
That's right.
All right, Duncan, what's the 7th topic that we're doing?
Okay, so this week we got over 60 really good questions. It was really hard to pick one. But Chris T asked a question that's definitely on everyone's mind. And he asked, during the first wave of the virus, we saw a broad market sell-off. If a second wave causes more shutdowns, what are your thoughts on how the market would react?
Such a good question. Thank you, Chris. All right, Mike, what do you think? If we have to do a second version of the lockdown, does the stock market react the same as it did the first time or differently?
I think that there can be pockets that react similarly. In other words, the areas of the market that are most sensitive to the shutdown, like airlines, cruises, I think can get clocked again. But the market as a whole, I don't think is going to go into free fall like it did the first time around, because now we have the roadmap. If this thing starts to get bad, we shut down and we do stimulus, and that's what I think is more likely to happen than a repeat of the first quarter.
I think I agree with you for the most part, because I also think that there are a lot of people whose baseline expectation is that we're going to have to do another lockdown this winter. So I almost feel like there's like a lot of expectation of that in place. And I also don't think you're going to see large cap tech drop 20% the way it did the first time, or even more. Like, I think that people now understand that not all publicly traded companies are going to weather this the same as the other ones are. And the ones that are like most vulnerable are tiny in the index. So I think you're right about that. Do you think investors will behave differently?
I mean, yeah, because I don't think that the knee-jerk reaction will be to sell.
So do you think investors will buy the dip so quickly that it'll almost be like the lockdown doesn't even compute in the way markets act? Because I can imagine that.
There might not be a dip. I mean, that sounds hard to believe. That sounds hard to believe, but who knows?
A lot of things this year are hard to believe. Okay, let us know what you guys think about the topics that we've talked about today. We love your feedback. We love mixing up with you guys on the live premieres every Tuesday evening. And by all means, send us what you want to hear us discuss for our final topic next week. Send it to askthecompoundshow@gmail.com. And we will be back with you next week.